Here's the uncomfortable truth nobody's telling you. Millions of Americans are sitting on a financial time bomb and they have no idea. After every video I've posted about the banking crisis, they ask the same question. What about credit unions? Are they safer than banks? Should I move my money there instead? Today, I'm going to expose the real answer. And I promise you, it's not what you think. I'm going to break down the hidden risks that credit union members rarely understand, reveal which regulatory system actually protects your money better, and give you a framework for deciding where your savings belong. Because the answer isn't as simple as choosing Team Bank or Team Credit Union. And making the wrong choice based on assumptions instead of data could cost you everything. Let me start with something that shocked me when I dug into the numbers. Most Americans think credit unions and banks are basically the same thing with different names. They're not. The structural differences are profound, and understanding them is the key to protecting your money. A bank is a for-profit corporation owned by shareholders. When a bank makes decisions about lending or risk management, those shareholders' interests come first. You, the depositor, you're just a customer. Your money funds their operations, but you have zero say in how it's managed and no claim on profits. Credit unions operate under a completely different model. They're not-for-profit cooperatives owned by their members. When you deposit money in a credit union, you become a partial owner with voting rights. The credit union exists to serve you, not Wall Street investors. Any surplus gets returned to members through better rates and lower fees. Now here's where it gets interesting. This structural difference creates competing safety factors that most people never consider. On one hand, credit unions lack the profit motive that drives banks to take excessive risks. They don't have analysts pressuring them to grow earnings every quarter. They don't have shareholders demanding higher returns that can only be achieved through riskier lending. In theory, this should make them safer. But here's the flip side. Credit unions typically operate on much thinner capital margins than banks. Why? Because they return surplus to members rather than building massive equity cushions. They have less buffer to absorb unexpected losses. Think about it this way. A bank with billions in shareholder equity can survive significant loan defaults. A credit union with minimal surplus may find itself in serious trouble much faster when losses start materializing. So, which is actually safer? That's where the insurance question comes in, and this is where things get really interesting. Bank deposits are insured by the FDIC up to $250,000 per depositor per institution. Credit union deposits are insured by the NCUA up to the same limit. On paper, these protections appear identical, but there's a critical difference most depositors never consider. The FDIC insurance fund currently has a reserve ratio of about 1.3%. The NCUA Share Insurance Fund has held steady at about 1.3% for the last 3 years. By this measure, they're roughly equivalent. But here's what changes the entire calculation. The FDIC has an explicit line of credit with the United States Treasury for up to $100 billion. And during crisis, Congress has demonstrated willingness to provide unlimited backing. When Silicon Valley Bank and Signature Bank failed in 2023, the government stepped in to guarantee all deposits, even those exceeding the insurance limit. And here's something that should shock you. Roughly 93% of Silicon Valley Bank's deposits were uninsured, exceeding the $250,000 limit. Yet every single depositor got their money back. The government essentially rewrote the rules overnight. The NCUA has a more limited line of credit with Treasury and has never been tested by a crisis of similar magnitude. If multiple large credit unions failed simultaneously, we don't know whether the government would provide the same unlimited backing. This isn't conspiracy theory. This is a genuine uncertainty that should factor into your decision about where to keep large amounts of money. Now let me tell you about the regulatory differences that credit union marketing never mentions. Banks are supervised by multiple federal agencies. The OCC, the Federal Reserve, the FDIC. These agencies conduct regular examinations and enforce strict capital requirements. Credit unions, they're supervised primarily by the NCUA for federally chartered institutions or by state regulators for state-chartered ones. The NCUA has more limited resources than the combined banking regulators. State credit union regulators vary dramatically. Some maintain excellent oversight. Others are stretched thin and may miss problems until they become severe. Here's something that should concern you. Approximately 1 in 5 federally insured credit unions currently has a CAMELS composite rating of 3, 4, or 5. That means they're exhibiting some degree of supervisory concern or worse. The number of troubled complex credit unions with $500 million or more in assets tripled in just 1 quarter. The amount of assets at these troubled institutions, it grew by more than 5-fold. One NCUA board member stated it's been about a decade since they last saw this proportion of insured shares at risk. But here's what really keeps me up at night. These regulatory actions happen behind closed doors, invisible to members whose money is at risk. Unlike the banking system where journalists and analysts scrutinize every regulatory move, the credit union sector operates with far less transparency. Problems can build for years before members even know their institution is struggling. Now here's where the credit union story gets really interesting. Because while they dodged the commercial real estate bullet that's destroying banks, they walked straight into a different crisis that could be just as devastating. And almost nobody's talking about it. The good news? Credit unions largely avoided the commercial real estate exposure that's destroying banks. Most focus on consumer lending rather than office buildings and retail centers. This is genuinely positive for credit union safety. But they face a different crisis that's equally devastating. Auto loans. Delinquent auto loan balances for credit unions are up 180% over the past 3 years. That's nearly double the national average and higher than any other lender type. For every $1,000 in auto loans that were delinquent 3 years ago, there are now $2,800 today. For the third quarter of 2024, the delinquency rate was 91 basis points, up 19 basis points from 1 year earlier. Think about what's happening here. Used car values, which soared during the pandemic supply shortage, have declined significantly. Credit unions that made loans at inflated valuations are now holding collateral worth less than the outstanding loan balances. Borrowers who owe more than their cars are worth? Some are simply walking away. The second challenge is interest rate pressure on mortgage portfolios. Like banks, credit unions loaded up on low-rate residential mortgages when rates were near historic lows. These mortgages generate returns of 3 or 4%, while credit unions must now pay 5% or more to attract deposits. This negative spread squeezes margins and erodes the thin capital cushions credit unions operate with. Unlike large banks that can offset mortgage losses with profits from other business lines, most credit unions are heavily dependent on the spread between what they pay depositors and what they earn from loans. When that spread turns negative, profitability disappears and the path toward trouble begins. Here's the third challenge. Member deposit outflows have accelerated dramatically. Why? Savers discovered that treasury bills and money market funds offer higher yields than credit union savings accounts. Credit unions, constrained by their not-for-profit structure and thin margins, often cannot match the 5% yields available in government securities. Picture a loyal member with $50,000 in savings earning 1.5%. She discovers she can get 5% in a treasury fund with zero risk. She moves her money in an afternoon, multiply that by thousands of members, and you see the problem. The result is a steady drain that forces credit unions to either shrink their loan portfolios or find alternative funding sources at higher costs. And here's what most members don't know. Some credit unions are now borrowing from the Federal Home Loan Bank system, taking on wholesale funding that's more expensive and less stable than member deposits. This represents a fundamental transformation of the credit union model happening behind closed doors. So how do you evaluate whether your credit union is safe? First, check your credit union's net worth ratio on the NCUA website. Federally insured credit unions need at least 7% to be well capitalized. Below 7%, not well capitalized. Below 6%, undercapitalized with increased scrutiny. Below 4%, significantly undercapitalized and may face merger or conservatorship. Second, examine loan concentration. If more than 40% of loans are in a single category, that creates vulnerability. A credit union with 60% in auto loans is far more exposed than one with diversified lending. Third, look at delinquency and charge-off trends. If loans 30, 60, and 90 days past due are rising quarter over quarter, your credit union is experiencing credit deterioration. Fourth, calculate a modified Texas ratio. Take delinquent loans plus other real estate owned and divide by net worth plus loan loss reserves. Below 50% indicates health, above 75% indicates stress, above 100%, danger zone. By the way, if you're finding this valuable, make sure you're subscribed because I'm breaking down exactly which specific institutions are showing these warning signs. The analysis I share here could literally save your family's finances. And drop a comment below telling me if you bank with a credit union or a traditional bank and why you made that choice. Fifth, examine size and track record. Larger credit unions with billions in assets typically have more diversified operations and more resources to weather difficulties. Smaller credit unions serving narrow communities may be more vulnerable to local economic shocks. Now here's my direct assessment synthesizing everything. Credit unions are not inherently safer or more dangerous than banks. They face different risks and operate under different structures, but neither model provides absolute protection. The commercial real estate crisis devastating regional banks has largely spared credit unions because they don't make those types of loans. This is a genuine advantage right now. However, the auto loan crisis building across the credit union sector could prove equally devastating to institutions with heavy concentration in that category. The fundamental question isn't whether banks or credit unions are safer as categories. The question is whether your specific institution has the capital strength, portfolio diversification, and management quality to survive the challenges ahead. You need to stop assuming your credit union is safe simply because it's member-owned and not for profit. And you need to stop assuming your bank is safe simply because it has a famous name. Do the analysis. Calculate the ratios. Make informed decisions based on data rather than assumptions. Should you diversify across both banks and credit unions? This strategy has merit if you choose strong institutions in both categories. Spreading money between a weak bank and a weak credit union accomplishes nothing except doubling your exposure to failure. Identify the strongest institutions using the analytical tools I've taught you. If you find a bank with excellent ratios and minimal exposure, that's a strong candidate. If you find a credit union with a net worth ratio above 10%, diversified loans, and low delinquencies, that's another strong candidate. Splitting deposits between two genuinely strong institutions provides better protection than concentrating everything in a single institution, even a strong one. But I need to be honest about something. The fortress banks like JP Morgan Chase and Bank of America offer systemic protection that no credit union can match. These are designated as globally systemically important banks. The federal government has committed to preventing their failure because the consequences would be catastrophic. This implicit guarantee provides protection beyond FDIC insurance. No credit union carries this systemic importance. We don't know with certainty how the government would respond if a massive credit union threatened the broader system. This uncertainty isn't a reason to avoid credit unions entirely. It's a reason to understand that the safety calculus is different and to factor that difference into your decisions. Let me give you exactly what you should do. First, evaluate your credit union using rigorous analysis. Check the net worth ratio, examine loan concentration, calculate delinquency trends and the modified Texas ratio. If any metrics show warning signs, take action immediately. Second, understand the insurance differences. Both FDIC and NCUA provide the same $250,000 limit, but the FDIC demonstrated unlimited backing during the 2023 crisis. The NCUA has never been tested at that scale. If you maintain deposits at both, consider keeping larger amounts at systemically important banks. Third, analyze your credit union's risk profile. Heavy auto loan concentration means elevated risk. Diversified lending and conservative underwriting may actually be safer than regional banks drowning in commercial real estate losses. Fourth, apply the same principles to any financial institution. Seek conservative management, prioritizing long-term stability. Demand adequate capital cushions. Avoid concentrated exposure to single asset classes. Value stable member deposits over funding that can flee during stress. Ask whether management has demonstrated prudence through economic cycles. Ask whether the capital cushion is adequate for portfolio risks. Ask whether deposits are stable or fleeing to higher yields. The answers tell you far more about safety than the legal structure. Here's the bottom line. Credit unions are neither a safe haven from the banking crisis nor a hidden danger you should flee. They're financial institutions with their own strengths and weaknesses, their own risks and protections, their own strong performers and troubled institutions. Your job is to identify which category your specific credit union falls into and act accordingly. The tools exist, the data is available, the analysis is not complicated. The only question is whether you'll do the work to protect your family's financial future or trust blindly and hope for the best. In times of crisis, the prepared survive while the complacent become statistics. Your money doesn't care about brand names or member ownership structures. It only cares about one thing, the strength of the institution protecting it. Choose strength, not slogans. If you found this valuable, watch another video here to stay ahead of what's coming next.